I'll just kind of kick this off right now. So hi, everyone. Thank you all so much for being here. Again, Lisa, thank you so much for your time and for being our guest speaker. Welcome to all the new community members. This is session 7 of the Veteran ETA Roundtable. And just a quick thing, Veteran ETA Roundtable is a community committed to veterans succeeding in entrepreneurship through buying business with tri-weekly recorded roundtable sessions, send out a weekly newsletter with resources to build upon those sessions, and then we have a community element with the Slack page where you can kind of just post whatever's going on. Quick housekeeping, I'm going to throw out a survey here in a sec just to kind of, again, I did it at the beginning, but I want to kind of gauge where everyone is and kind of where in the process so I can better tailor the resources. And so the way this is going to go, Lisa's going to provide a great presentation and then field some questions. We were just saying, definitely, pop in with a question on camera. If you want, you can also message the group, or if you're worried about the question, you can message me and I'll be happy to ask Lisa, but preferably I'd like to hear Lisa talk a lot more than me. So, and then one quick thing, this is, just a quick disclaimer. None of this is legal or financial advice. Okay. So, real quick, I'm just going to give Lisa's bio and just a quick intro. So Lisa Forrest is widely recognized as a national go-to resource for proficiency SBA lower middle market M&A deal structuring. She specializes in guiding searchers and SMB acquirers through transactions of up to $25 million in enterprise value. Lisa has over 35 years in experience in the banking industry, bringing a wealth of expertise to the role as the head of Live Oak Bank's search fund lending vertical, facilitating transactions up to $50 million in enterprise value with the blend of SBA and conventional loans. Before her time at Live Oak, Lisa was the director and business development officer, Bank of California National M&A Lending Division. Her extensive background also encompasses leadership roles in business development at Union Bank and Fortune Bank. Additionally, Lisa managed overall banking operations as the CEO for the Money Store / First Union. Lisa has an undergraduate degree in finance and economics and an MBA degree from California State University, Sacramento. Lisa is frequently featured as a guest on leading podcasts, business podcasts, and has been a featured keynote speaker at multiple ETA conferences nationwide. I was very fortunate to meet Lisa last year when I was maybe a little more than that, when I was getting into the ETA space. And I was like, hey, I really think veterans are really well positioned to succeed. And she was, absolutely just so supportive of me. And I know that talked to a lot of veterans that have had wonderful interactions with her. So it's really just terrific to have you here, Lisa. And thank you so much for your time. And the floor is yours.
All right. Well, thank you so much for having me. Really appreciate seeing a lot of familiar names here in the boxes. And I would like to set this up. I know, Charlie, I know you're taping this for the wider distribution, but let's make it as interactive as we can with the folks that have joined live. I'm great with you guys taking yourselves off of mute and asking questions as we go along. We'll take a look at the chat. Charlie will help me with questions, but I'm good with taking off of mute. I think that makes for the most interactive session. I was planning on sharing my screen. I do a weekly office hours at Live Oak Bank, and some of you on the call today are going to get a little bit of rehash of that because you just saw it this morning, but I was going to use it as a jumping off point. I moderated a session last week for the NVSBC where we are talking about awareness for entrepreneurship through acquisition for a military veteran. So I have some topics that we covered there. I was basically the civilian in the whole event, but I was honored to moderate 3 veterans that joined me, and I had them explain their story of how they got from the military to this idea of ETA. I know, Charlie, you're speaking to a kind of a wide range of listeners here, so I'm going to try to toggle back and forth. But if we can use everyone live here, take yourself off of mute and ask questions, we'll just kind of keep it going. So what I was going to do was share my screen. And am I sharing it appropriately? This is always the thing. Am I showing you my email inbox? Feel free to answer some emails for me. But are you seeing screen self-funded search weekly office hours? Okay, good.
Yeah.
All right,
Yeah.
terrific.
Yep.
So I largely was going to come at this from an SBA perspective today, self-funded search. We find that a lot of our military veterans, especially maybe coming to forums like this, it seems like we have a lot of veterans that are really exploring going self-funded using the SBA program, where you're going to potentially own the vast majority of the business opportunity. Not that we don't have very successful, traditionally funded searchers. We've got several that I have been lucky enough to finance that have gone the traditionally funded path and gone the uh, conventional path. But for today's purposes, I thought we'd maybe cover more of the SBA. And then again, Charlie, you moderate, you cut me off. I can talk about this all day long. Obviously, I have been doing that today. Same stuff I talk about all day long. So direct me where you want me to go. So I'm going to go through some of the verticals that we cater to at Live Oak Bank. This is just an idea for those on the list on the podcast today or just listening. I think some of the ideas are like, well, what industries are good industries? Would I even resonate with my background from coming from the military for business ownership? And I'm just going to say, hell yes. Your background resonates and translates extremely well. I call it the double bottom line. One, first of all, you have been serving your country. Now you have the opportunity to create wealth for yourself, and that's okay. You are allowed to create wealth for yourself and your family. You have the ability to create wealth for your employees, give them a real path to wealth for themselves. You get to continue to serve your country via serving the economy. All of that seems to resonate really, really well for our veterans. You're amazing operators. And also for me, having my job is to finance business acquisition, and I've been doing this for 37 years. It also just makes me feel really good. It's just a really fun thing to do, take our military veterans and be just a small part of putting them in a position to have the kind of impact and maybe some more stability in their lives based on where you've been and how many years you've been moving around. So it's just got so many double, triple, quadruple bottom lines to it. So so keep exploring this path. You just make amazing operators, and happy to talk to people one-on-one. There's so many organizations out there that will help you. For those of you that are earlier on your transition, there are amazing organizations out there that help you translate your military resume to the civilian resume, and it translates really, really well. So I'm just going to kind of leave that pitch there as kind of backdrop to all of my comments going forward. So a lot of times veterans want to ask about, well, what industries are even out there for me to think about? We're industry agnostic at Live Oak Bank as one example. This is not meant to be a commercial for Live Oak. I'm just going to use it just to kind of base some of my comments. So at Live Oak, for our business acquisitions, we are industry agnostic. We have no idea what our business acquirers are going to come to us with, what kind of industries. I put this up here just as an example of 30 or 40 different verticals at Live Oak, and we're the nation's #1 SBA lender, so we do a whole bunch of business acquisition. These are the industries that we have catered to, that do well, that have a lot of scale behind them, that have growth in these industries. So it's just one example of some things to think about. And not that coming from the military, you have to have some sort of blue collar aspect to a business. Not at all. It's just that other business acquirers, other acquisition entrepreneurs, they're interested in like blue collar spaces. They do really, really well. And even people coming out of private equity, highfalutin consulting, investment banking, these are the industries in which private equity is kind of coming in and scooping up industry. So I put this up here just as an example. So for the folks on the call live, any questions you have around industry specific, and then I'll keep moving on if we're not having any questions here.
Lisa, I would just ask, I know a lot of people have been talking about gov contracting. Do you see that a lot, or how like, is that like all veterans, or kind of what's the percentage breakout there, if you have anything on that?
Of course, GovCon, as you can see, is one of our verticals. It is a very, very active vertical for us. Obviously the idea from government contracting, it dovetails really well with our military veterans and women in business and minority and underserved categories. It is a very popular arena for us. We do really well with it. There are nuances around it, though, that make it, unfortunately, a little difficult. And it is are especially if you're a veteran owner of GovCon and you're trying to now exit to the next generation, and there's some rules around the veterans needing to be the 51% owner, which make it a little difficult maybe in the conventional lending sense, because a lot of our conventional loans, the operator actually ends up owning a smaller amount of it. It could lend itself really well to the SBA world, especially in this context where our owner operators are the ones that are going to be having the majority ownership of those companies, even if you're going to bring some equity investors in. So that's kind of a long-winded answer to, yes, GovCon is very popular, and we have two amazing vertical lenders there that we collaborate a lot with. So if anyone is interested in GovCon, please reach out. I'm happy to get you connected to real strong industry experts in that space. And I know GovCon with some of our veterans, it's kind of a love-hate kind of thing. I think it could be a great opportunity for you, but I know coming out of the services, sometimes the GovCon doesn't necessarily have some of the best reputations. So that's for all y'all to decide if that's something that is going to resonate with you. But I got people for you to talk to. And then it looks like solar new construction. Yeah. So Austin, yeah. So for Live Oak anyway. And this is where there are so many lenders out there. This is all about finding the right fit. I'm going to give you kind of my perspective because you're talking to me, but there are lots of lenders out there with lots of different perspectives. And one of the nuances around the industries for us, and for you too, you should be asking questions around ties to new construction, ties to cyclical industries, seasonality, project work. These are all the things that make the lending decision, and then also your decision as the acquirer. Those are all the weeds you have to get into. For us, majority ties to ground up new construction, whether it's residential or commercial. That's got ebbs and flows into it. You've got really high swings in construction. I think it's been on an upswing now, but over a long period of time, there are kind of ebbs to new construction where it can have really strong booms and busts to it. For us at Live Oak, we're trying to keep our new construction to maybe a maximum of 30%. And that could be in lots of different industries. That could be in HVAC, that could be in plumbing, that could be in anything, even hardware, any hardware stores that are catering to contractors. So lots of different industries can have ties to new construction. We're trying to limit the amount in our deals that we're looking at. Project work is where you've got maybe you've got 30 different customers and they're all bringing revenue to you at different times over any given 1, 2, 3, 4 year period of time, and you can have inconsistencies in performance. So again, those are some risks that you're going to want to get into. And then lots of seasonality. You have a business that does business in November and December, and no business during the rest of the time of the year. So those are qualitative nuances that you're going to want to get into and work with lenders that are going to help you understand those. Yeah, seasonal swings can be really, really tough. And it might be okay for someone that already owns a company that is buying a second company, and you can kind of merge different seasonalities. So project work, new construction, these kinds of swings we were talking about in seasonality may be okay if you are a business owner buying for the second or third time, but just really think about the nuances when you're the first time acquirer. You really want your first acquisition to be sort of as smooth as possible. So with the SBA loan program, I think I'm just going to go ahead and just dive into some of this project structure. Perfect. So this is a typical deal structure, and I'm going to say for Live Oak Bank, and then I'll compare and contrast to other lenders and how you can have different schools of thoughts on certain things, because I'm not here to tell you this is the only way to do it. Not at all. It's about having the right fit. I consider myself to be, more of a coach and a mentor. I want you to come to your point of view. I want you to have your own understanding of things over time. And you want to find the right fit when it comes to lending. one lender could be a really good fit on this type of opportunity. Another lender could be a better fit on the next opportunity you're looking at. So it's not necessarily a one size fits all, and don't let anyone tell you that it is, because it isn't. You need to come to your point of view, and that can take a period of time for you to get there. So with an SBA transaction, it is typically 10% down. That's equity from you and or your equity team. So 10% down in total from you and your equity team. Generally, I would think that most lenders probably want something meaningful from you equity-wise. Meaningful is going to be something different for everybody. That's at least how we approach it. We want some meaningful amount of equity down payment from you. And then the bulk of the rest of that can be made up from equity investors, minority equity investors that you're bringing into your cap table. So 10% down, then 10 to 15% seller note. And then generally the SBA loan is sort of 75 to 80% financing. Now there are SBA lenders out there that are sort of more comfortable doing less amounts of equity injection and using your seller note to count for some of that 10%. If your seller note's on standby, that means no principal and interest being paid for 2 years. Then your seller note can actually count for your 10% down payment. You just need to find the lender that has a fit, if that's how you're resonating. If you've got a deal where that really makes sense and you're behind it and you're feeling comfortable with it, it's about finding the lender that's going to go that low with equity. I think a really good rule of thumb, if you have a deal where 10% down works and it's between you and your equity investors coming to that 10%, and then you've got some amount of seller note, 10 to 15%. And again, the SBA loan might be sort of 75 to 80% of it. I think you've got a really good basis for a good structure. And there's lots of nuances around that, but not to overload too much. But if you just think 10 down, 10% seller note, 80% SBA, I think that generally kind of gets at the heart of it in most cases. Now, the structure of all of that and how much debt you can really take on between the SBA loan and your seller note, it's going to be all guardrailed by debt service coverage. And what I mean by that is adjusted cash flow over your SBA loan, annual loan payment, plus your seller note payments. At Live Oak, if I am industry agnostic, I want your cash flow to cover your total debt payments at 1.5 times or better, pre-tax in the last full year. Now, we were talking about verticals that we know really, really well. In these verticals, we'll actually go down to about a 1.25, maybe a 1.35 debt service coverage, because we know the industries well, and we really know the questions to ask you. If we are learning about the industry alongside you, which we do a lot, we are learning something new every day, then philosophically, we want a little bit more debt service coverage to give you margin, to have room for the things that were not considered during diligence. And there is always something not considered during diligence, even in the industries we know really, really well. So we want you to have enough margin to get through that uh-oh moment during transition post-close. There is always an uh-oh moment. I will tell you right now, very few lower middle market transitions go without any sort of hiccup. And not that there was any fraud or anything nefarious going on. It's just that these are quirky small businesses, and for you to be able to think about everything in a transition plan, it just doesn't happen. Even the sellers, most of the times the sellers are first-time sellers. They're not even thinking about everything. Everything's in their head. Most of the time, they've never had any policies and procedures, and they miss telling you things too. So we want enough margin to get you through transition and hopefully give you enough room to be able to organically grow your company, so you're not just paying the bank back. Lenders are going to have different debt service coverage comfort levels. You eventually are going to come to your own point of view on what you think that debt service coverage should be. So it is a kind of journey to get to what those right answers are, and they can vary from deal to deal. So with that, for now, Charlie, what questions you want to throw at me, or anyone on the live stream here? What questions you got for me?
When it comes to the initial capital injection, so the 10%, does it matter in terms of whether it's personal capital, investor capital, seller note, et cetera? Does that change the likelihood of approval or the total loan amount that will eventually get approved by Live Oak Bank?
So, and I'll take kind of the bigger picture view on this too, not have too much Live Oak commercial on you. The amount of debt that is going to be allowed all stems from what I was just talking about. And there's this idea of debt service coverage, cash flow, adjusted cash flow over the annual principal and interest on your SBA loan plus the annual principal and interest on your seller note. Sometimes we're going to want a 1.5 debt service coverage, and sometimes we might go as low as a 1.25 debt service coverage. I think a lot of lenders out there are probably more closer to the 1.25 debt service coverage level. So just the amount of the quantum of debt that can be afforded is really going to depend on the as-is performance of the company you're acquiring. Not that you're not going to have your investment thesis and what you're going to do to the company post-close, all of your growth plans. I know they're there. We're excited for you on your growth, but we base our debt on you getting in and kind of doing no harm. So if you get in, how much can the company as is afford to pay debt-wise? And then the nuance around that 10%, yes, it can be a combination of you, whatever's meaningful to you, and that meaningful is going to be different for everybody. Meaningful to you, plus your equity and investors, that has to equal 10% down. For the most part for Live Oak Bank. SBA does have a new rule that came out last May, that some of the seller note can count for your equity check. Technically, it can count for up to 100% of your equity check. If it is on standby, meaning no principal and interest for 2 years. That's what I was getting at with some of my comments before, but thank you for asking me to clarify. So the seller note, if it's on full standby for 2 years and then amortizes after that, it can count for up to 100% of your down payment. So you literally could be getting 100% financing between the seller note and the bank note.
Okay. And the full standby, it's 2 years, it's not 10.
In the new rule, it is 2 years.
Okay.
A year before, 2 years ago, it was 5%. 5% of the equity could count if it's in your seller note that was on full standby for 10 years.
Okay.
Personally, for me, I kind of like that rule better, but that's okay. There's lots of different ways to get deals done. And again, it's about the fit on that particular deal with your lender and your point of view. But it is 2 years standby, no principal and interest for 2 years. That can count for actually up to 100% of your down payment. You just have to find the lender that's doing it that way.
Sure.
I just highly caution not over leveraging. And then there are some lenders that don't actually count the seller note in their debt service coverage calculation. So make sure you know how your lender is calculating their debt service coverage. A lender could say yes to something that you might actually think is too aggressive. So just make sure you know. And then the limits on the borrower limits, I'll get to that next. So I'll bring that one up next. So with the $5 million limit, SBA does, I'll just go back to this slide here. So with SBA 7A, you have up to $5 million to borrow on a loan amount. Your project cost could be higher than $5 million. That's the maximum loan amount. So in our column 2 here, and many more banks actually have this junior conventional piece or a pari passu piece now. So that means that at Live Oak, we can give you a $5 million SBA loan, and then we can actually pair up in second position or a pari passu position additional Live Oak or other bank debt. So we can potentially get to a transaction size of 8, 9, 10, maybe even $12 million of enterprise value. Now, you're probably not coming in with 10% down because these are going to be bigger EBITDA companies driving a higher purchase price. So in order for the debt service to work, you're probably coming in with 15 or 20% down. And then the seller note might be, not 10 or 15%, it might be 20% on a longer term. Again, debt service is going to drive how the structures are kind of calculated. So in this case, we're not taking your retire. Well, one, the SBA, anyway, we can't take liens on your retirement. Now you could do a Rob's, rollover to take the value of your retirement out for down payment. Maybe that's what you're talking about here. We're not going to take it as collateral. Again, we are coming at these from a cash flow perspective, not a collateral perspective. So we're not going to take your assets in lieu of down payment, if I'm reading the question in here correctly. And again, I'm going off of debt service coverage as to how much debt we're going to give you. And there's several banks out there now doing 5 million plus their bank conventional debt to get you into a larger transaction. So hopefully I've answered that question correctly in the anonymous there. If I have not, okay, good. It looks like I did. Okay, terrific. So I'm going to get through some of these here. Let's talk about the process, and then I can kind of go back to some other these concepts at any time. So I know out there, especially if you're going through a brokered process, brokers want to see your pre-qual letter before they'll even give you a SIM. And we're not coming at this from a home loan perspective. We're not basing our decision on your W-2 salary. We're basing our decision on the historic ability of the company you want to buy to cover the debt service. So it's hard to pre-qual you when we haven't even seen the deal in front of us. I'll get to the pre-qual part. But what we did is we created like a support letter or a letter of comfort that maybe you can show to your brokers. If you send us a resume, we can actually give you a support letter. We want to know your operational chops, not so much your personal financial statement, because especially since there are equity investors out in this ecosystem can help you bridge gap on equity. I want to know more so what's your background and could you operate this company? So if you send us a resume, we can provide a letter of support. I do believe other SBA lenders out there are also probably providing pre-qual letters as well. Just wanted to let you know that it's not, I don't know how much I can lend to you before I see the deal. So we try to do a little compromise on coming at it more from your operational chops perspective. And I'm just looking at some of the questions here. So I've got some questions here. Let me keep going through the process here, and then I'll come back to some of these debt service coverage questions, just as long as we're on the screen. So basically starting with some letter of comfort, and at Live Oak, we will help look at deals with you. We'll go through pre-LOI discussions with you. I think that a lot of banks will also do that with you. We have an executive summary template and a cash flow model we can share with you. So that if you want to talk to us pre-LOI, there's some homework you have to do. Don't just give us the broker sim. I want to know what you think. It's part of our process of getting to know you. And then also, it's helpful for you in learning your own point of view on how you think about a transaction and why. So there's an executive summary template and a cash flow we actually provide to our searchers. I think that helps in the second phase where you're talking to us pre-LOI. You actually have an LOI signed, and that's where banks will come out and actually give you a pre-qual letter or a term sheet, because now we have your deal in front of us. We know exactly how much debt it can afford, in our opinion. And if it's something that we think we can get done with you, we actually talk to our senior credit officer about it. We issue you a term sheet. And then it's generally about 90 days to close, 90 days from signed LOI to close. We kind of that underwriting process from signed term sheet to underwriting commitment letter takes about 30 days. And then it's another 60 days to close. And that's not just you getting your bank loan. It's all the other things you have to do in your M&A process. A lot of it involves your attorney on the purchase and sale agreement. A lot of things that are going on that are between you and your seller. Getting your bank loan is one of those things, but it takes about 90 days for that all to happen. So I'm going to take a pause, Charlie, and look at some of the questions here. So how does the SBA and Live Oak view the seller injecting capital back into the new entity as an investor during an asset sale? So that's not exactly how this works. So there is a partial change of ownership now that's allowed. That's new. You are literally buying into the seller's entity. It's a stock sale. You're buying into the seller's entity, and then the seller's going to retain some amount of ownership. If you are actually talking about the seller rolling equity into your asset sale, SBA still doesn't allow rolled equity. They do allow partial buy-in. It's a stock sale. You are literally buying into their company and they're retaining some amount of ownership. If it is an asset sale and you want the seller to roll ownership into your entity, SBA still doesn't allow that. And so they're not going to be injecting capital into your asset sale. SBA does not allow that. If I answer your question correctly there, if I got to the meat of it there for you, Weldon. So we have a question from Jerry, which is a really cool one. So SBA now allows another 5 million. I'll go back to this where we're talking about the SBA limiting 5 million bucks. That is per NAICS code. We are working on a couple of these now. SBA has come out with a new rule that if, say, you bought into HVAC and now you want to buy an MSP, managed service provider, 2 separate NAICS codes, we can actually lend you up to an additional $5 million on a new NAICS code. So we're really excited about this. We're actually starting to do some of these now where we have experienced operators in one industry buying into another. They've gone through their integration, they've transitioned, and now they're thinking about a different industry. And we're lending additional dollars over and above the 5 million into new industries. So we're really excited about that one.
Hey, Lisa, if I can, I kind of just wanted to chime in live on that question because it was my question there. With that, are there any nuances that you want to see in that other deal, like a time limit between the previous acquisition or certain covenants or contingencies on the existing business that are in there? And then I'm looking at it specifically, let's say from a GovCon perspective where you have, one NAICS code, but you can, do a strategic acquisition of another very similar company that has, it's another NAICS code that's in there, but they're really similar and it would be a great strategic acquisition.
Yeah, that's great. That sounds like a great idea. Love that idea. Everyone always asks their lender, could I buy another company 3 months from now? I bought my first one and now I want to, I have an opportunity to buy another one right away. Well, if we're lending you $5 million plus on the first one, I mean, that's going to be a pretty good transition to get through. So I don't have a real solid answer for you. We're gonna want to make sure that you're through your integration on your transition on the first one, and then your integration plan on how you're going to run 2 companies at the same time. Do you have common managers that can help you integrate? If they're 2 completely separate industries, then that's that's going to have its own integration conversation about just your time management, especially if they're geographically separated. So I'm really not answering your question so well in that I'm just going to raise up a lot of things that we're going to ask you about. But I love the idea. Certainly a year.
That helps. Thank you.
Yeah, a year and a half in, and you're buying your second one. I think that's probably going to work really well. I know sometimes though you get an opportunity and it's faster than that. This is the other thing. I know I'm giving you more on the answer than you bargained for, but a lot of times what happens on your first acquisition, you have a J curve. Your EBITDA might go down in the beginning. So now your EBITDA has gone down because you're growing it, you're doing things, or maybe you've had some kind of hiccup on a transition. Now your EBITDA has gone down and now you want to buy another company. So these are all the kinds of things we deal with when we're talking about strategic acquisitions. But I will say about 30% of our volume at any one point in time is for us doing additional loans for existing clients. So we do, at the end of the day, do a lot of strategic acquisition where we're giving you additional dollars for second, third acquisition. So we do like it. There's just a lot of nuance around it in order to answer a real specific question. So vehicles as collateral. Your personal guarantee is going to be secured by real estate if you have it. Daniel, the SBA is meant, though, to be a cash flow program. It's not a collateral-driven program. Anyone who owns 20% or more is going to give us their personal guarantee, but we're coming at this from a cash flow lending perspective. If you notice, most of my comments, all of my comments have been around debt service coverage, transition, qualitative aspects. We aren't going to be looking at your personal financial statement from the standpoint of needing to collateralize your like car loan or your car. And we could talk more about that. A lot of our searchers do and acquirers do not own their own real estate yet. And we're looking at the quality of the cash flow and the ability for the existing company to cover the debts that you're asking for as far as loan goes. So hopefully that answered that question for you. Okay, what else, Charlie? I know we're kind of coming up on our 45 minutes here. What else you got for me? I can keep going.
This might be unrelated, but I've spoken with some folks that do kind of M&A advisory or SBA loan advisory, and they talk about, you know, I've heard good things from certain folks about working with these partners, but could you just talk maybe quickly from your perspective what that payment structure looks like for them? And, you know, the pitch that I've gotten is that, you know, it's not going to cost searchers anything additional. They get paid on the back end from the bank when the loan goes through. I don't know if you kind of had any insights into that industry that I kind of see emerging.
Like a loan broker. So
Yeah,
it's a loan broker. You know, there's varying opinions there. I would say that there's value for both. There's value in working directly with a lender, and then there's value in working with a loan broker. The value for the acquirer working with lenders directly is that they really know how this process works. There's no filter. They're the ones making the decision. You have to know how to do your own cash flow. You got to know how to do a debt service. You have to know what qualitative aspects are involved in the decision making. I think there's value. You're about ready to take on a personal guarantee for a $4 million loan. To me, you probably want as little filter as possible on making those decisions on who your lenders are going to be. Having said that, if you have a very tricky transaction that is piquing your interest and it's going to be tough or rough finding lenders, then you probably want that help on loan brokers that might have a wider net. And sometimes you have to call 50 lenders to find the lender to finance your deal if it is a little bit outside of the you know, kind of, if it's not in the fairway. If it's in the rough, then you might need loan brokers to help you. If you really understand the deal yourself, please understand the deal yourself. Do not let anyone filter that for you. There's even people like writing your own business plans for you. I mean, you're about ready to sign a PG on a $5 million loan. I think you better have the skill set to write your own business plan. That's my soapbox. So I think it's going to depend on the deal that you're looking at. And I think that there is value for both.
Okay.
But I think, yeah, am I getting out with the question you were asking?
Yeah, and I was just curious how the pitch that I've heard from these brokerage firms is that it's not going to cost the searcher anything.
Sure.
Is that actually correct?
Yeah, that's true. Generally, banks will pay loan brokers.
Okay.
But there's not just the cost involved.
I got you.
It's what they're doing. They're taking work off you for sure. I get that. But it's the hard work that also is important.
Perfect.
So you've got to have the right deal in order to, I think, you know, I think certain deals might require that loan broker, where certain deals might be better for you to be direct in the trenches, making sure you fully understand how this loan is working.
Great. And then I got a question yesterday from a veteran about how to optimize SBA debt purchasing power when there's multiple members. Say there's like an LLC, maybe even like a partnered search, or there's 3 members in an entity vehicle that's planning on purchasing, you know, business, and around the PG and like what individual needs to be on that PG. And if one of them is on that $5 million loan, does that free up the other individuals to PG a second SBA loan, or is it all kind of per SBA rules go all the way back to the parent entity that's acquiring. That makes
So
sense.
it goes down to the individual basis.
Okay.
If you've got 3 partners, quote unquote, if you've got 3 partners, and you're gonna have, if you're all 33% owners on one deal, you're gonna use up all the guarantee there. If it's a $5 million transaction, you're 33% partners all on that transaction, then your $5 million is being used up, each one of you all together. So you can't, you're not getting a 33% of 5 million because there's 3 of you on this one. So sometimes we see, if you're trying to do a roll up or a hold co strategy, which I know is really popular, then what you might have to do is, if you're the partner taking this one on, then you're going to PG $5 million. If your 2 other partners are individually below a 20% ownership on this transaction, then they in theory wouldn't have to personally guarantee. Then, but if you're all up in the hold co and you all own the same amounts in the hold co, that could negate your ability to go out and get different deals. So individually on each loan, some of you would have to stay below 20%.
Okay, great. Yeah, because they were discussing maybe like a subordination and debt agreement that would, allow for the others to be on the hook for that person in their PG. And I was just kind of curious how the SBA views that.
If you own 20% or more individually, you have to personally guarantee. You can't then get fancy and say, well, I'm just going to sign a subordination or something like that. But if you're talking to someone in particular specifically, I'd be happy to chat with them.
Okay, great.
Yeah.
I know that's kind of a specific and kind of in the weeds question.
Okay. But that's okay. I mean, the partnered search is really popular, and I think it's great. I think a partnered search is fantastic. Just know that if, anyone who personally owns 20% or more has to personally guarantee. So, I mean, you can't negate that for SBA. And I would say for that, if you've got 2 or 3 partners, if you're literally going to be, and I use partner in the word in like you've got 3 of you, 33% in one transaction, it probably means you're going to have to buy a bigger business. Because if you all need to take salary from the business to meet your personal living needs, and now you're taking 300 grand out or something, you're going to have to buy a bigger EBITDA company that's going to be able to support a $300,000 salary. Most of the transactions we're looking at, they're lower middle market, so they're really supporting more of like $100,000 of salary, because you need to add back all of the owner comp in order to make the debt service work. So that's the only kind of downside when you have multiple owners together in a partnered search. You just have to buy a big enough company. But I think that's the idea going into it.
Definitely. And then, like you said, am I correct to say that you could, use that additional SBA loan availability with a different NAICS code or something, like we were talking about earlier, if you wanted
Exactly.
to. Okay, great.
Yeah.
Lisa, I've heard you mention for the searcher's equity injection, you like to see meaningful. I've heard you use that specific word, and I'm not holding it to a specific answer as far as I understand. It's deal dependent, searcher dependent. Do you have a baseline on what you're underwriting to? Is it based off of personal net worth, any sort of personal debt ratios? Can you speak a little bit more to that?
Sure. It's based on how much cash you have. How much liquidity do you have? How much 401k do you have? How much liquidity do you have?
Right.
Do you have the ability?
All of that.
What's that?
So my if a deal pencils with, let's say, 4 investors at 22% equity injection, and you're going to take a low salary, personally you want to hold back some injection personally. So do you see deals you hear the podcasts of, oh, you could buy a company for $5 million with without injecting any capital personally? Do you accept any of those deals? Do you look at those, or do you always want a meaningful injection from the searcher?
We want meaningful to you.
Yeah.
What is meaningful to you? And this is in a forum like this, I would have to talk to you offline. Like I'd literally need to say, Jim, how much money you got? Let's talk about this. What do you got? What do you have compared to, you know, somebody else? We are working on transactions where we're doing large dollar loans where we have most of the equity coming in from the equity investors. We are absolutely doing those, especially for our military veterans. We've got quite a few of those where our military veteran is injecting what is meaningful to them. It's a lot less than compared to someone that's been in private equity that is in their 40s.
Sure.
Meaningful to my private equity mid-career searcher is a lot different than a 35-year-old, you know, Marine coming out of the services. Those
Sure.
are definitely different meaningfuls.
Thanks.
I know this is subjective, but can you give it a kind of an example of what was meaningful to somebody in a specific deal, just so we can kind of get an idea of how they, just how they guaranteed that deal personally.
Makes me a little nervous to do that, but I will.
Okay.
So $25,000 of cash injection on a $5 million loan. Don't hold me to it. Don't say Lisa said. Now this is on a podcast. Like 5,000 people are saying Lisa said I only need $25,000 and you're going to lend me $5 million bucks. So, you know, that was meaningful to that person. Their military, and it was a military veteran. Their resume was amazing. They had a very strong deal. They had very qualified equity investors helping them bridge that gap on equity. I can put about 10 more qualifiers on that. I just don't want to, you know, I know how this works. It's like, oh, Live Oaks, you don't need any down payment. But $25,000 to that person was meaningful, extremely meaningful. And then there were other good things going on there too. We had a good, great seller note. I mean, you know, I could go on with why we decided that that was okay on that deal, where $25,000 on a different deal might not pencil for us. Is that helpful, Val?
That's helpful to me as well, Lisa. Sorry, I didn't mean to put you on the spot. I
Oh
appreciate.
no, that's why I'm here. That's why I'm here. I was just so noting that you put me on the spot. I
Yeah.
went ahead and answered it anyway.
I have another question. I don't want to, you know, if it, so the other question is, in terms of, you may cover this, I don't know if you plan to, but what does a person's personal credit have to look like before they embark on the search journey?
Well, the easy answer is it should be good. It should look good. You know, I'm like 650 and above. I don't know. We that sounds like something that we might want to, if you've got any concerns, I would say for anyone out there, if you've got any concerns about your credit report, let's talk early. Talk to your lender early on about what the issues are, where there may be a concern. But I'd say 650 generally minimum.
And Lisa, we got a question in the chat. What level of QE does the bank typically require? Do you recommend paying for a separate or deeper level of QE than what is required by the bank?
So actually, from an SBA perspective, the SBA does not require a quality of earning report. The SBA requires a business valuation. Those are two different things, accomplishing very different things. The business valuation is going to sort of try to confirm the multiples that you're paying in the industry. The quality of earnings is an audit of the financial statements and usually working capital audit in there. The SBA does not require it, but I would say that for the most part, at least the clients that I work with are already wanting to require quality of earnings. In this SBA space, they're generally referred to as Q of E light. They have all of the numbers and the workbooks, just not the fancy narrative and all of the pages of narrative explanation, but it's doing all the math. I'm going to say generally that's probably between $10,000 and $20,000 for the quality of earnings light. And I mean, just ask your fellow business acquisition acquirers. They normally will tell you it is worth the money, because what the Q of E generally does is it probably in there and it scrutinized the EBITDA, and generally the EBITDA doesn't quite confirm at the level maybe that the sellers were trying to stipulate. And it's not that they're trying to be fraudulent, but you know, the QV is really in there doing an audit. So if you pay 15 grand on a quality of earnings report and it saves you, you know, 300,000, 200,000 of EBITDA, you know, that's going to more than pay for it in the differential on the price that you're going to pay if you're able to negotiate a lesser price. So generally the QV pays for itself with regard to a lesser price or some improved structure.
Great. And then a follow-up is, does the buyer's capital towards Q of E / a CPA and legal fees count towards the meaningful equity injection we've been discussing?
Yeah, so with SBA, your CPA, your Q of E, your attorney fee can all go into the total project cost. And then you need that minimum 10% down on total project cost. And if you are paying for quality of earnings as part of that total project cost, absolutely, that could count toward your meaningful contribution.
Great.
So how much time we got? About 5 more minutes?
Yeah, I think so. I mean, I really appreciate your time. Kind of see if there's any additional questions, but Lisa, do you have anything else that you'd kind of like to share, some closing thoughts or?
Yeah, I would just say that you know, interest rates are I've just got two more charts because people do like to talk about where interest rates are now. Just to put it in context, where we've come since 3/16 of 2020. And 3/16 of 2020 prime was at 3.25. It's now at 8.5. And then there's a spread on top of that 8.5. So the difference in affordability for the loan amount, basically on a 1.25 debt service coverage, you could afford $1 million less loan, all things being equal, with that jump in interest rate. So the affordability has come down about 22% since the beginning of 2020, when interest rates really plummeted. So in the last year, in 2023, there was a huge adjustment in lower middle market. Sellers were coming off of some of maybe their best years ever in 2022 as far as performance. You know, there's a lot of COVID catch up in there, but they were coming off their best years ever. And now you could afford 22% less of, you know, their best year ever. So there was a big adjustment in 2023. Same time last year, there was a lot of confusion out there, where interest rates going. And then plus, at least for those going SBA, then these new SOPs were being introduced and they were all over the place. They weren't confirmed. We had a lot of confusion same time last year. I'm feeling very, very optimistic where we're at. I think we know where interest rates are. Are they going to come down a little bit? Probably. When? I don't know. This is kind of really a stabilized interest rate. And I think for companies coming out of 2023, the performance is sort of known now. For folks buying in the middle of 2023, there was a little bit of a question mark whether that performance was stabilized or sustainable. So now we've got 2023 financials sort of in the can, if you will. We kind of know where interest rates are. There is so much interest around entrepreneurship acquisition from so many service providers, so many banks, equity investors, and just business buyers themselves. And there's still a lot of sellers out there. There's just a lot of momentum in this space. So I'm feeling really positive about it. Perfect.
All right. Couple more. Do you have people are coming in hot with some good questions here. Do you typically suggest getting a seller's note even if not required to finance the deal? Are there other ways of maintaining seller involvement, accountability other than a seller note that are accepted by the SBA rules?
So, I mean, the SBA actually doesn't require a seller note. They do not require a seller note. If you're coming in with your 10% down and the bank is okay with doing 90% financing, the SBA doesn't require a seller note. I think industry standard has always been that a seller note is really important because there's no covenants around an SBA loan. So you have the bank has no fallback. If something starts going off the rails, there's no other levers to pull on. and for you, if something's going off the rails, there's no other levers to pull on if you don't have a seller note. So, and it's going to be deal to deal and lender to lender as whether a seller note is required or advisable in that transaction. A seller note is there to mitigate something. And there's always something to mitigate in a lower middle market deal, trust me. So if you are not negotiating a seller note, then maybe an escrow holdback might be something to do that can help tie the seller to it. But if there's no seller note, if you don't have an escrow holdback, I don't really know what else you've got to tie the seller to the deal. If you're doing a partial buy-in, that might be a way to do it. You do a partial buy-in, they still have some ownership, they still have some impetus to do well and help you with the transition. That might be a way to do it. Seller notes have just always been a really good way to manage that. And if you've got, it sounds like this person might have a specific deal in mind. So I'm always happy to talk about why or why not a seller note might be okay in that deal.
Great. And then final question that I'm seeing in the chat is, do you see any trends in recapitalizing years after a successful SBA acquisition, perhaps pay off a seller note early and or get rid of personal guarantee? Are there limitations to doing so?
So keep in mind with an SBA loan, one of the benefits of an SBA loan is you get a 10-year term. A 10-year term really moves the needle on affordability. So generally, and especially if it's in this sort of $1 million EBITDA range, generally you have to get into a much bigger transaction, a much bigger EBITDA before your personal guarantees as a bank requirement are going to go away. So if you bought a $3 million company that needed the 10-year term to make the deal work, in 2 or 3 years, if you go to a conventional loan because you want to get rid of the personal guarantee, now you're going to maybe a 7 or a 5-year term. Generally, the debt service coverage doesn't translate because you really needed that length of term to make the numbers work. And for most conventional lenders, commercial lenders, your personal guarantee is probably going to be required for quite some time until you get into a pretty large transaction. So I never try to overpromise at all with the idea that, oh, stay in the SBA loan for 2 years and then you can refinance it. I don't really see that as being a really realistic path. Now, paying off a seller note, if they're in second position, a balloon's coming due in a couple of 2, 3, 5 years, and then maybe you can use more SBA loan to refinance your seller note. We see that happening a lot. The seller note has to be amortizing interest only. Some amount of payment has to be on that seller note seasoning for 2 years before it's eligible for a refinance for an SBA loan. But that's probably a little bit more realistic than you just getting out of your personal guarantee if the SBA loan was the only path for you at that time.
Terrific. All right. Well, we are past time. So thank you so much, Lisa. Do you have anything you'd like to close with, or I think you've nailed everything?
No, I think I was using my closing comments. So I think it's a great time. I've been financing business acquisition for over 30 years. There are always good deals out there. These aging baby boomers, they've got to sell their companies. So it's, I get the question asked all the time, oh my gosh, did we miss our window? No, the window's going to be there for a very, very long period of time. Just make sure you're preparing yourself and then just finding the right fit with your deal team. And it can happen, especially for our military veterans. I'm even more optimistic about it.